been a gut-wrenching fall for Indian markets, and in last couple of days, the fall has been nothing short of straight line. How should one read into this straight line fall? Are concerns of liquidity, at least in the debt market, are they real, or the selling is largely sentimental and liquidity driven? Is it a time to put money to work, or for the moment one is better off sitting on cash, putting money in debt and liquid funds, because in the run up to the election market volatility is going to be high? Is good news giving you good price, or there is a challenging environment which is here to stay? So to discuss all that and much more, I have with me Navneet Munot, Executive Director and CIO with SBI MC. Navneet, fantastic to have you back. Thank you for joining us.
My pleasure.
What's going on? It's been a gut-wrenching fall. It's been a straight line fall. If I look at the screen and suddenly when I see a Nifty 50 stock like Indiabulls Finance crash by 30-40%, it reminds you of 2008, 2013.
So maybe I think we discussed at the beginning of the year that this is not going to be a calm and peaceful year like 2017. It's going to be a lot more volatile, and also particularly down the capitalization curve will have more pain. So if you see the market YTD, Nifty is up around 7%, Sensex is up around 7%, Nifty up 4%, BSE 100 maybe 2%, BSE 500 negative, midcap minus 14%, small cap minus 20%. This is a mirror image of what has happened in last 3 or 4 years, and I think that was writing was on the wall. Particularly on the sector that you talked about, I think let's take a step back. Last few years, what really happened? What led to the massive growth in the non-banking finance sector? You have 3 balance sheets in a country: government, corporate, and households who borrow money. Government was deleveraging because they wanted to reduce the debt to GDP. Corporates were deleveraging for a variety of reasons. The household balance sheet was in a great shape 3-4 years back, which could take the leverage. And other factors, the formalization of the economy, the digitalization, ample liquidity helped the non-banking finance sector. Banks had their own set of challenges. A large part of the banking sector, some are in PCA, some are in different kinds of trouble due to the stress asset resolution. So there was a huge space for the non-banking sector to grab that. But in finance, I've seen over the years that whenever the growth is much faster in a particular segment, some problems crop up. And so when some of the finance companies, they took leverage which was much higher than what they should have taken relative to the asset quality that they had, we have seen some bit of problems arising. And that has happened because liquidity was ample for last few years, and they were a big beneficiary. You borrow short term, you lend long term, there is a huge spread to make, and now suddenly liquidity has tightened because of rupee, because of variety of other reasons, and then rates have moved up, and then you are in trouble when you have to roll over those maturities. And then this whole episode of a AAA rated entity defaulting, and then it just complicated the situation. Going forward, my sense is that in last few years, people who could grow the asset side faster were commanding a premium. I think now people will realize the value of the liability side. Who's got better liability franchise? Some of the banks also, I think they will grab the market share back which they have lost in last few years.
That's a great point, because in a country like India, growth is unlimited.
Yeah.
If you're a good NBFC or a good bank, you can always raise capital.
Yeah.
The third part, which is the liability, it's only when the tide turns you find out who's been doing the wrong things. Okay.
So as Buffett said that, and I know when, I mean maybe in few months, few
so have you
quarters
sold
when
all
we'll
your
do that.
NBFC stocks?
And I think as Buffett said in 2008, when the tide turned, we knew that everybody was swimming naked. And I think again, something similar can be said, that when the tide turns, we'll see that how many probably segments or how many people in the market were swimming naked.
So the tide has just turned. Do you think we will see more and more skeletons out of the cupboard? And are the headlines for NBFC companies or NBFC sector per se, will that only get uglier and uglier going forward?
I don't think so. Two parts to it. So few years back, if you remember, we used to discuss that how the formalization of the economy, digitalization, differential regulation, and also the disintermediation is a structural trend where savers come to mutual funds, the borrowers go to the non-banking sources. These are structural trends. And in India, a large part of the informal lending, informal borrowing which was there is now moving to the formal channels. Not that banks can get the entire, can serve all the segments. There would surely be a lot of space for the NBFCs who are more agile, who have invested a lot more in technology. I think particularly those who have managed their balance sheets well, who are very good in their risk management, whether it's the credit risk assessment, whether it's the recovery mechanism. I think those people with a stronger parent they will do well. They will continue to do well because, as you said, I mean, in India, we are still starting from a very low base in terms of debt to GDP across all segments. So I think there will be space, but I think maybe the boys versus men will get probably.
How, as the AMC, you are positioned in financials now?
So both on the debt and equity sides, we have been cautious. As I mentioned earlier, that I think the liability franchise, which wasn't as important in a period where you had ample liquidity, which also got amplified after the demonetization. So I think it was your ability to grow the assets faster was more important. I think we have diversified a lot more. I think today we are focusing a lot more on those stronger, I mean the NBFCs or banks with a stronger balance sheet and a stronger liability side. And of course, it goes without saying that you have to have very strong standards on the underwriting and on the risk management.
So what happens to typical retail dominated banks like an HDFC Bank or a Kotak Mahindra Bank, or perhaps a retail dominated NBFC like Bajaj Finance? Because we may argue that retail is where the growth has come in, but retail is where, Navneet, so far the delinquencies have not been there. CIBIL and other risk management systems are ensuring that the retail borrower is not being able to default.
So this is the mistake that people make. Okay. If you go back in history and check, as I said, 3 balance sheets that borrow money, any time where there is excessive growth on the one side, that leads to a trouble. So in 2008, it was the household balance sheets in US. 2011-12, it was the government balance sheets in Europe, parts of Europe. If you see the last, I mean the financial crisis in Asia earlier, or the recent one in India, it was the corporate balance sheet. In any balance sheet, regardless of the lower base, when the growth is much faster, much faster than the income growth, it will lead to some trouble. Because when a lot of money chases a particular sector, underwriting standards get diluted, some of the wrong practices come in, and that leads to some trouble. That's why I keep repeating, I think those who have maintained their balance sheet well and have a very high level of I would say, extremely prudent risk management, I think they would do well. Particularly on the bank side, so you mentioned about some of the retail banks. Yeah, the so-called corporate banks also have a massive retail franchise. Let's not forget that. They have strong CASA on liability side. Their ability to raise liability even other than CASA is huge, and they have a large retail franchise. Last few years, some of these banks had their own set of challenges on the stressed asset side. Now, as that gets resolved, I think they will focus on retail. So I think some of the market share from the NBFCs is likely to shift back to the banks.
Okay.